self-directed IRA and buy the properties from the IRA. And if you flip it over, you'll see he would have got a $3,400 refund instead of owing $9,000. Plus, the 10% penalty that he got, the 10% times 47,000, that would have been extra money that he would have had to invest in the property. So it cost him a lot of money. And that's why you should always ask your tax advisor before you go and do something. And this is something that my firm does. Now, I'm going to give you another example, the difference between myself and other CPAs. Because as Alex said, not all properties or real estate agents are created equal, neither are CPAs. I had a client come to me, he has a rental property, but he also has an LLC that has some properties in it and that he's going to flip. Well, on the surface, you would think that you would prepare the tax returns, have the rentals on there, but he was over the income threshold, okay, which is $100,000. If you make over $100,000, you are not allowed to deduct passive losses except against other passive income. Well, he only had one rental property in service and it lost money, and he was over $100,000, so he wasn't getting the deduction for the rental property. When I sat down and looked at it, I noticed that he had this other property that he was holding, that he was renovating in an LLC. And typically what happens when you're holding a property and it's not in service and you're rehabbing it, you can't write off anything. You have to capitalize all those costs until the point that you either put it in the service by putting it out for rent, or if you put it on the market to sell. So, what I did is I sat down, I analyzed the situation, and I called him, I was asking him some questions about the property, and he told me, well, I just sold it in February. So he bought it in September, sold it in February, had a nice gain. And what that allowed me to do is show that he was actually in the business of flipping houses. He now turned a passive activity of rentals into a trader business of flipping houses. And what that does is that freed up about $8,000 of costs that he had in searching for new properties, so on, so advertising, et cetera, et cetera. So he was able to deduct about $7,000 in costs. That put him beneath the threshold for freeing up the passive losses. So not only was he allowed to write off those expenses right away, he was also able to write off the unallowed passive losses because of the income threshold. And that turned him from owing $2,000 to getting a refund of $3,800. Just because I picked up the phone and I asked them questions. And a lot of times people get annoyed when I call them and I ask them questions. They're like, why are you asking so many questions? No one ever asked me questions before. That's the difference. You go to H&R Block, you go to someone else, and if they don't ask you questions about what you're doing and what your business is, they're not doing you a good service. And you're paying exactly what you're getting. With that being said, I need to make money too, and I get paid by the hour. So when I bill you, you're going to get a return on your investment. I can guarantee you that. So don't think you're wasting money or spending money by paying me. Because if you think that, I'm not the CPA for you. Because I am an investment. Okay, so ready for the new tax law? There we go. Number one thing, and people don't realize this, they think, oh, the tax law is passed, we're ready to go, we can apply it to the tax form, we can apply it to our situation. That's not true. The last big tax law change was 1986, and there are still rules and regulations that aren't written or clarified or litigated about that tax law. So this brand new tax law, it's going to be years before everything is clarified. And one of the biggest things in here, in this tax law, affects real estate people. And that's whether a real estate business or a real estate and venture is considered a trade or business, or is it just passive income or an investment? And we'll talk about why that's important.
Matt, can you explain what's a trade or business? What's the difference between all three?
Well, investment, passive investment versus trade or business. Like you as a real estate agent, you're working, you're doing work. And we'll get into that a little later, but that's a trade or business. You're actually in the business of selling homes or being an agent, as opposed to just investing in property on the side. And he loaded the wrong one. Where'd he go? He just left the room. That's the business one. I wanted to talk about the later stuff. That's right, you've got the slides in front of you. We'll wait till he gets back for that. But let's go to the first slide. Says many changes. Okay. As I said, there's going to be a lot of changes going on as the IRS and the Treasury Department has to write rules and regulations to implement the new tax code. And as I said, one of the big things is in regards to real estate investors. And here is a letter that the American Institute of Certified Public Accountants sent to the IRS saying, these are all the items that we need clarified right away. And one of those things is in regards to, does real estate investment count as a trade or business? Ian, I need you to pull up the other one. Okay, the other thing you need to keep in mind is just because the IRS changes their laws, PA doesn't change theirs. There are many provisions in the tax code that PA does not accept just because the IRS says that they're going to do something. One big example is the Section 179 deduction of expensing equipment. Another thing would be bonus depreciation. Those things affect real estate people a lot. So just because you can write off a $25,000 asset for the IRS doesn't mean that you can do it with PA. Some of the basic changes, they changed the tax brackets. So if you were in, like Alex, the highest tax bracket, 39.6, you are now in the 37% tax bracket. If you were in the 15% tax bracket, you're now in the 12% tax bracket. They eliminated the dependent exemption. So if you have children, you no longer get a dependent exemption for yourself, your wife, and your kids. That's gone. However, they did double what you will have for a kid for the child credit. So instead of getting $1,000 per child, you get $2,000. And that's if their kids are 17 and under. If they're over 17, you'll get a $500 credit. Now, one thing you may have heard about is a lot of people take the standard deduction. Some people itemize. Yes.
When you have investment property, don't you have to itemize?
No.
Properties?
Absolutely not. It has nothing to do with itemized deductions. Rentals go on Schedule E for rental properties, or they could go on Schedule C. So as I was talking about the child credit there, increased standard deduction. Right now, okay, to simplify this, the IRS would give you $12,000 unless your itemized deductions are more. And what that includes is your income tax, your real estate taxes, your mortgage interest, charitable contributions, tax preparation, things of that nature. If that was over $12,000, then you would, of course, get those deductions. Well, what the IRS did, or Congress did, is they doubled that now. So next year, you get a standard deduction of $24,000. So if your expenses aren't more than 24, you take the standard deduction. Okay? For single people, it went from, I'll use round number, 6,000 to 12,000. So a lot more people are going to take the standard deduction. I guess that's what they considered simplifying things. But what they also did, it seems like they want more people to take it, because they limited what you can deduct for real estate and income taxes to $10,000. So if your real estate taxes are $7,000 and your income taxes are 12 or 5, you only get to deduct 10 of it instead of 12. Skip over AMT. This is an important slide right here. The dividend and capital gains rates were unchanged. And for real estate investors, this is where we want to live. We want to live in this 0% for married filing joint taxpayers. There's actually a 0% capital gains rate. I'm not sure if anyone knew that. But if your taxable income, not gross income, taxable income is $77,000, any of your capital gains, whether it's stock or selling homes or investment property, you can get 0% tax. And I just had a situation where someone had their mother transfer their house to them because she was going into some nursing home and they didn't want Medicare to take it, so and so. Usually that's a horrible idea, because there's a saying that you want to die with your losers. I know it's morbid, but you want your parents to die with the house, because when someone dies, that value, they may have paid $30,000 for it, but it's worth $125 now. So if they die with that house and you go and sell it as the heir, your basis is now $25,000. So if you sell for $25,000, your gain is 0. Whereas if your mother gave it to you, your basis is now $30,000. You go and sell that house, you just had a $90,000 gain. I see it all the time. I've seen it twice already this year. Now luckily, it worked out for them because they ended up being in this situation and they paid no tax on it. No tax.
Is it taxable income AGI?
No.
No.
AGI is adjusted gross income.
Right, I know.
Okay, that's the split between above the line deductions and below the line deductions. Taxable income is AGI minus your itemized deductions, or your standard deduction, your personal exemptions, and now this new thing called qualified business income deduction, which is going to be a flat 20%. Now, and that's what we're going to talk about mostly for real estate investors, is how do you qualify for that 20% deduction? And how do you determine, or how do you make sure that your real estate investments qualify as a trade or business? And doing research for this speech, there are a lot of people out there just saying that real estate qualifies, and that is not true. It is absolutely, totally not true. And I'll tell you why as we move on. Other things we have to worry about with real estate investments is trying to stay out of ordinary income tax rates, which can be as high as 37%, plus the net investment tax is if you make over $250,000 and your real estate is considered an investment, you're paying an extra 3.8% tax on that. It's called the Obama tax. Also, with becoming a trade or business, you get to pay an extra 15.3% in self-employment tax income. That's the difference, Al. That's the difference between a trade or business and an investment. If it's a trade or business, it's considered your livelihood, you get to pay self-employment tax on it. But that's not always a bad thing.
Doesn't that caps at some point, Matt?
Yes, last year was $128,000. So
So once you make taxable income of $128,000, then that self-employment tax goes away completely?
if it's self-employment income, like if you have a W-2 and you make $128,000 and you pay the self-employment tax on that, if you're able to have a trade or business also, and that is subject to self-employment tax, that will not be, because you're over the threshold.
Matt,
Yeah,
so basically, if you have all your rentals in maybe one LLC, that's all your passive income. It's taxed totally different. And then you have another LLC, and in that LLC, you can put any of your ordinary income that's considered, income. Like if you do a wholesale deal or you rehab, you're selling it before the year's out. If you're a realtor, any commissions, like all that could be another LLC because that's standard ordinary income. Correct?
Correct, that's one of the strategies that we employ and try to advise our clients about, is trying to make sure that you don't taint your passive real estate income with that brush of self-employment tax by doing flips and rentals all in the same LLC. So you want to try to separate those two. Okay, as I said, they're trying to get more and more people to do the standard deduction. And some of the other things they did is they, and this is important to a lot of people because a lot of people will go out and get a home equity loan and use it to pay off their credit cards or buy a car or invest in real estate. And that is no longer deductible. And I was at a meeting the other day, and a banker stood up and he said that. He said, it's no longer deductible. Don't go and get a home equity loan. We've seen a large drop off in home equity loans now, line of credit, so on and so forth. It's not true. It says it right there in bold, but it's not true. Because if you have a good CPA, we know there's something called interest tracing rules, which means that even though that's a home equity line of credit, you have to trace where you use that money. And if you use that money in a business, or if you use that money for a real estate property, that's where the deduction goes. You get to deduct it off of your business income, or you get to deduct it off of your rental. So, when someone says that, it's not true. So that's where a good CPA comes in. Now, here's something else that we have to deal with all the time, and most people don't even realize. This was part of the tax law right here. No more miscellaneous itemized deductions. They got rid of it. Well, with the new passing of the budget in February, Congress decided we're not doing that.